Mate, have you seen all the earnings coming out?
They've been decent.
Yeah.
Apple came out last night with decent earnings. Buybacks. Everyone's too cashed up.
Yeah.
Nowhere to invest.
All right, let's get to Riverside.
Did you read that Bill Ackman
No, I haven't.
tweet?
I saw it. I haven't.
And it's pretty good.
What's he saying?
So he goes, the regional banking system is at risk. SVB's depositors' bad weekend woke up uninsured depositors everywhere.
Yeah, that's true.
The rapid rise in rates impaired assets and drained deposits, zeroing out shareholders and bondholders, massively increased the bank's cost of capital. CRE losses loom. Meanwhile, higher yield, more user-friendly alternatives beckon. Hashtag Apple. That's interesting. If Apple gets into the banking sector.
Well, they've already got their deposit account. Have you seen that?
No.
Yeah, they've got like an Apple account.
Wow.
They're paying like 4.6%.
No way.
Yeah. I don't know what the inflows are.
It's pretty amazing. So the FDIC government failure to update and expand its insurance regime has hammered home more nails in the coffin. FRB would not have failed if the FDIC temporarily guaranteed deposits while a new guarantee regime was created. Now we watch dominoes fall and great systemic and economic cost.
Yeah, possibly. But also the three banks that have failed this year, they've been gobbled up.
Yeah.
And so I just wonder whether the US starts becoming like...
Well, the deposits are gobbled up, but the shareholders, everyone else is burnt, right? So...
Yeah. I mean, that's the risk
What
to take, right?
What does it say for, we keep talking about hybrid securities and bank hybrid securities and they're...
Yeah, but I just wonder if like America's becoming more of like Australia where you have this like a real distinction between your big banks and then your credit unions and whatever. Guess how much Apple has drawn into their bank account?
How much?
I'll take a wild guess.
$3 billion.
$1 billion.
$1 billion. It's pretty good.
It's offering 4.15 now.
What are they investing in?
What's Apple investing in? Their own stock. I don't know. I don't know.
They're obviously using that money.
I mean, how else are they going to raise capital? I mean, they could issue a bond.
Yeah. Well,
I mean, what's
probably cheaper than a bond at 4.6.
Probably with where rates are now.
I think we're probably cutting into our podcast topic a little bit.
Are we? Are you going to talk about that?
No, talking about yields.
Banking is a game of confidence. Yes, at this rate, no regional bank can survive bad news or bad data. 100%. I'm going to talk about that as well. Stock price inevitably plunge. Insured and uninsured are withdrawn. Pursuing strategic alternatives means an FDIC shutdown over the coming weekend, and then no incentive to bid until Sunday after the failure. Yeah, it's like JP Morgan. They picked up First Republic. They pick it up for nothing now.
Zero.
Yeah, nothing. Yeah. Okay. Anyway, let's
kick off.
You ready to go? Is this recording?
I don't know. Are we recording?
Yeah, I think so. Welcome everyone, episode 41 of the Wide Lens podcast. I've got my co-host here, John Sim, and we're going to cover the latest topics in financial markets. We're recording this on the 5th of the 5th, 2023. Do you reckon on the 5th of the 5th, 2025, there'll be a lot of weddings? Don't people like to have that sort of...
Something easy to remember. Yeah.
No one remembers that stuff, right? No. Let's get into market wrap and have a quick look at how global markets have been performing. I'll get this first chart up now. This is the last 5 days. And I've just realised I've brought the wrong chart up. So we're going to skip that now, and we're going to go straight into the year-to-date numbers because my last 5 days' numbers are all buggered up. But year-to-date, let's have a look at Australia. Man, Australia was so promising out of the gates at the beginning of the year. Financials, value stocks, mining stocks, just to the moon and just fizzled out.
Yep.
Shit the bed. And we're sitting at 3.5% total return, mind you, for the year. We have, sitting slightly behind the Australian stock market, we've got the Vanguard, or got emerging markets, sitting at 2.7% total return. European markets sitting in the middle there at about 8.5% for the year. Again, I'm sorry, that was the S&P 500. Man, I am not on ball this morning.
Need your coffee.
The S&P 500 up 8.5%, and the one that continues to rally pretty hard is the European market, up 15% for the year. And man, I think this one continues to surprise. The NASDAQ up almost in excess of 21%. Again, this is total return. 21% year to date. Any thoughts or comments around, I mean, we'll probably get into it a little bit later on, but just high level, like why the Australian stock market fizzled out? Is that just like a banking interest rate story? Commodities prices are cooling off. Like what is that? What do you reckon that is?
It's a good question. I'm not completely sure, to be honest.
What about tech stocks? Why is everyone buying tech stocks again?
Oh, they were severely punished last year. Towards the end of last year.
Do you reckon that's what it is, or is there anything else? Like potentially, if you have to invest your money somewhere, you're investing it in businesses that actually have got, I mean, we'll talk about earnings later on, but are making money. You've got money in the bank.
Yeah, we talked about it in an earlier pod, I think, regarding these big tech companies having massive amounts of cash flow. I think innovation for them, they haven't really innovated since the early 2000s. If you look at Google, Facebook, Apple, when the iPhone came out, those were all early 2000s. So they're not really innovation stocks anymore. They're pretty mature companies with strong balance sheets, strong cash flow.
I don't know if you saw Meta when they had their earnings the other day, that they've spent $30 billion in their AI division. And they keep pushing on this, and the quarter after quarter losses just keep getting bigger and bigger and bigger. And if you have a look at, so they spent $30 billion so far in their AI division. Microsoft bought ChatGPT for $13 billion. And if you look at the contrast between what Meta's doing and what Microsoft's doing, it's day and night.
Well, it's now a race, right? Who can monetize AI the quickest? We all know it's here to stay. It's probably the next great leap in technology, and will add the most value to established economies around the world in terms of use cases. I've got some interesting stuff later. I'll show you.
All right.
But yeah, I think it's almost like an arms race.
I introduced my two boys to ChatGPT. They love ChatGPT. We created bedtime stories, so they tell me like what characters they want to be in the story, and because I don't want to read thousands of words of books, so I'm like maximum 500 words or maximum 1,000 words.
Fantastic.
And they'll tell me the characters. They tell me the plot that the story needs to be, and then it just starts.
And now you can use Midjourney and create the images and actually create your own books.
How good would that be?
Yeah, it's fantastic. I think it's a great business idea. People email in their stories and their characters. Maybe they use their kids as characters, and you can basically implant them in these digital worlds and print these custom books.
I mean, people do them already. People are talking about AI, and AI is going to take away the creative. Yes, I agree with that to some extent, that there may not have to be someone sitting there and physically drawing sketches or on Adobe or what have you. But I think the abundance of software now and the technology that's available, man, you need someone to manage all of this now, right? Like the image generation, the voiceover, the copy. Like, who's going to do all this? So
there's going to be new jobs created out of it, and things that we haven't even 100%. Fathomed.
I saw this. Saw a newspaper clipping. I can't remember what year it was. Decades ago. There were teachers protesting the calculator, saying students should not be allowed to use the calculator. They should have to understand and learn how to calculate math. And the picture was contrasting that to AI, saying no, students should not be able to generate reports and whatnot on AI. They should know how to do it. And it's just it's just natural evolution that we go through, and no one likes this disruptive change to always face. But I don't know. I grew up with a calculator. I still understand how.
Well, it's the
math
improvement
works.
in efficiency, right?
Yeah.
So you can calculate things a lot quicker, and therefore, you know, your ability to generate new things is a lot quicker. It's almost exponential. Things are
100% it is.
things are going so fast. Suddenly, you know, we're ChatGPT 3, now it's ChatGPT 4. Now there's all these services where I think there's some plugins where, you know, if you need to organize a holiday, it's effectively, you know, like a Jarvis from, you know, Iron Man, where you just go, hey, build, you know, I want to go to this place, I want to spend this amount, and I want to do these sorts of things, and it can go into Kayak or you know, a Goda or whatever it is, and book everything for you,
and just sort of build your itinerary.
And book it all.
And book it all.
And so do everything, do all the bookings, and basically be your travel booker.
Yeah. It's mind blowing. And I sent you the other night, because you sent me something on Instagram. I sent you the Chat GPT. So it was Chat GPT, but it was showing the robots. Did you saw the video?
Yeah, I sent that to you. Yeah.
Oh, you sent me the robots.
Oh no, you sent me the robots.
I sent you the robot. Man, that was scary.
Scary.
If anyone's seen just what's going on with robotics and AI and robotics in military, it'll freak you out. What was that movie, iRobot?
Yeah.
And there's a number of other ones that have been out. Like
so Palantir have just come out with an AI
robot.
That no, it's almost a brain for military strategy. So what they're saying is it can survey the whole landscape of the battlefield and tell you probability-wise what are the best tactics to use, based on you know what artillery and armory and everything that you have versus what they have. What's the best course of action?
Oh wow,
it's nuts.
How scary is that? Like, how far away have we How far away have we gotten from just human connection to like the world, the planet, to ourselves, to each other? You just find that we're just, you know, miles away from it.
100%. It's scary.
It is really scary. All right, we are well and truly off topic, but over to you, man. What do you want to cover?
I thought we'd go with green tech this morning. There was some really interesting article in Bloomberg this week around copper. So Rio Tinto have just opened a big copper mine in the Gobi Desert in Mongolia, and basically it's taken them a hell of a long time to open that. I think from memory, four decades in the making.
Wow,
four decades. And
who initiated that? And then who?
So there's, you know, obviously a combination of them exploring, finding the target, getting all the government support. So there's all these sort of red tape and hurdle to
I mean, like from a Rio Tinto perspective, like which, you know, who was
had the foresight
or tasked with this to be able to see it through for this long?
Oh, it's amazing. And Rio's now making efforts to move beyond their dependence on iron ore and into copper, because what they're saying is that copper is going to underpin the transition to clean energy.
How?
So I guess there's copper being used in all the clean energy infrastructure.
Right.
Yeah. So they're saying that actually there's not enough supply of copper in the next 10 years to drive the energy transition and carbon zero. And there's just not enough copper deposits being found and developed globally. So they're saying right now they're short about 6 million tons of copper in the next decade, which means building 12 of these crazy new mines. So if you look at, we'll bring up the image of the copper mine, but it's a massive mine that they've got there.
Wow, that looks like something out of like Star Wars or something, like on another planet.
It's crazy. And the way that they're mining this supposedly is pretty unique. That can, only a handful of companies around the world can actually mine that. It's a big problem. Exploration's yielding a lot lower grades of copper and a lot smaller mines as well. So that's a big issue. Copper mines are taking a lot longer to develop. They're, on average now taking, if you look at the image there, based on mines starting up in or after 2010, you're looking at, underground and open pit mines taking 10 to 12 years.
Do you know what's interesting? Like the destruction of the planet, we're always talking about carbon neutral and trying to do the right thing by the planet, sustainability. It's like you have to go through this process in order for you to get to where you want to be, which is on face value a better outcome than using fossil fuel and other minerals and whatnot. This is really interesting to me.
Yeah, but there's widespread destruction as well in terms of economic environment, right?
So what happens to that massive hole in the ground? Is it a big swimming pool? Like, what do you do with that?
I'm not an expert. I don't know whether they fill it or what happens to it after at the end of mine life. But yeah, that'd be an interesting one to get a mining specialist on board to see, whether, what's the environmental impact of all this. And with ESG requirements now, I'm assuming there's a hell of a lot more red tape to get some of these mines operational.
Maybe that's why it took them 40 years.
Which means supply, yeah, that's right. Which means supply again is going to be a big impact. And so, deals are back now. If you're looking for copper deals, they're back. Glencore has been moving on Teck Resources, a long coveted copper target. You've got gold miner Newmont bidding for Australian peer Newcrest in a deal that will add bullion as well as copper to its production profile.
Yeah,
BHP's just completed an acquisition of a copper producer, Oz Minerals, in its largest deal in over a decade. So it's becoming a big focus for a lot of these big producers. And given, number one, the reduced investment in exploration and the existing mines getting deeper and lower grade, there's a lot of M&A activity in the sector.
Yeah, that's fascinating. I'm really curious about what happens to the mines afterwards. I mean, I'm sure it's a very basic and knowledgeable thing for those in the game, but I've got no idea.
Yeah,
It just looks like a massive hole in the
we'll have to
ground.
look that up later. But bottom line is their supply's got to come from somewhere, so they're creating new ways of extraction as well, taking recycling, being able to extract copper from lower grade ore and even mine waste. And I'm sure as humans, we'll find more ingenious ways to find the copper we need. But yeah, there's obviously a really big shortfall. So copper futures.
It's the thing,
We'll see what happens to copper futures in the next couple of years.
Yeah, look, commodity is just a thing I've got no idea about. Like, they're just constantly evolving. Things are always changing. 1 minute it's copper, 1 minute it's iron ore,
Rare
minute
earth.
it's lithium. The next minute it's like I can't keep up. Leave that to the experts. All right, I want to talk about raising the rates. Unexpected rate rise in Australia the other day by 25 bips. US also raised by 25. That was probably more expected than Australia. We looked and chatted last week about the gap between US Fed fund rates and the 10-year, which has been the biggest we've seen over the last 30 or 40 years, I think it was from memory. Australia was pretty line ball. The 10-year and the cash rate were almost on par with each other. And we were talking about, look, if this isn't it, if this isn't it, there can only be like another one or maybe two. I feel like we've been saying that for a lot longer now.
Yeah.
Always another one or another two. So Australia was surprising. US was probably less surprising. Powell and the RBA have started to have become a bit more dovish. I mean, I think we talked about that a couple of weeks ago. Apollo had a chart which showed central banks around the world becoming more dovish than hawkish, and that seems to be becoming more emphasised over the last month as well. Powell also started dropping hints that they may be looking to pause in June, so what do we May? So next month, and that's something that we saw last time. In fact, back in June 2006, with similar commentary, which was the end of the last rate hike cycle before the GFC. Powell was talking about encouraged by the trajectory of the labour market, fewer job openings, lower wage growth, greater labour participation, etc. And we'll get the jobs numbers tomorrow our time for the US, which is US's Friday. But the bond market now continues to bet against the central bank's move that it's going to be cutting, despite what the Federal Reserve's saying and doing, and that the inflation outlook doesn't support easier policy.
Interesting.
Quote from Bloomberg: "The market is sending a clear message that the Fed tackling inflation is fighting yesterday's battle." I don't disagree with that. We saw Australian inflation coming down by 10% month on month or year on year each month, and I think the ComSec analysis that you brought up in last week or the week before's pod, showing that RBA or inflation, as long as we continue this current trajectory, we're going to be in target towards the back end of this year. Currently, the US 10-year Treasury is sitting at 3.351. In fact, I'll just bring this chart up real quick. You can see the 10-year Treasury note have a look at the March. It's in excess of 4%. Really, we're down to your sort of lower threes. That's a big drop. Massive. In a matter of March, April, couple of months. If we continue to see that, then you've got rates coming down, inflation doing what it's doing, and we'll keep going. One thing that I found really interesting. This is from Deutsche Bank, and I'll bring this chart up now. For those that are watching, you can see that chart up now. For those that are listening, the real Fed funds rates with forecasting using inflation swaps and Fed fund futures out to June 2023. I'll quickly just try and explain this as best I can. I'll read from Deutsche Bank. One of our big themes over the last year or so was that every Fed hiking cycle has taken the spot real Fed's funds rate to positive territory. So why should it be any different this time? Or in other words, the hikes have taken the Fed funds rate above the inflation rate. It might seem obvious now, but it was some way out of consensus last year when a far more dovish hiking cycle was expected. So we can see a couple of extremes here, and I think it was Volcker period back in the late 70s where we had real Fed fund rates pushing north of 8, getting close to 10%. The other extreme we saw during COVID, and you see real Fed fund rates just getting absolutely clobbered here. Deutsche Bank gone to say, obviously we can debate whether the R-star is relative to the past, but if the real policy rate is up to plus 2%, then that's closer to the 2% to 4% ballpark of where it's been in many previous hiking cycles pre-GFC. There have been two major outliers. I just talked about the Volcker and COVID. Given the lessons from our recent experience, it's hard to believe we'll see negative 8 real policy rates again in our careers, even if you're just reading this for your internship. My big picture thoughts are the Fed funds might not be high enough yet to bring inflation back to target organically, but that we're now only in the early stage of the policy lag from 500 bips of hikes in 14 months. We have likely already seen enough tightening to cause periodic stress in the system and a recession by the end of 2023. That's what Deutsche Bank are of the view that we'll have recession second half of 2023. I'm just going to give you a dump, and I'm curious of your thoughts. This is from Apollo. The US household balance sheets are in excellent shape. US households, the ratio of liabilities to net wealth has declined 50% since the 2008 GFC. 50% decline. Household leverage is currently levels last seen in the early 1980s. Wow. If the unemployment rate rises, consumer spending will slow. But the starting point for the US households is very, very strong. I mean, that deleveraging that we saw during GFC has been incredible. But I think also one of the big things we can't forget about is the fact that we've had asset price inflation or asset price rising, we've called it whatever you want, since the GFC. So
That's
the last
right.
15 years, right?
Yeah.
Yes, there is evidence that households are reducing their debt, but the game here is asset prices, right? That's been helping absorb all of this and providing a lot of equity for households.
So the question is, I guess, more than when you're looking at it in terms of the servicing, right? Whether at the current debt levels, whether their servicing requirements are any different.
Well, you're 100% right. What we're seeing now, and we spoke to Andrew Papageorgiou a few weeks back when you're away. He's also saying that we're seeing the numbers from the warehousing that we're invested in, and he says there's no stress.
Mm.
And that's the really interesting thing for me, because the thing I've been always thinking about is when these fixed rate loans expire, which they're happening right now as we speak. We've had a big chunk of them already happen. That's going to cause something to break. But what's happening is that, and it might take a little bit longer because people have got savings that they've had for quite some time. So we've got to chew through that first.
Yeah.
There is naturally a lag, and that's my next chart actually. In fact, it's about 14 months is on average how long the lag is from rate rise to impact on the real economy. Maybe we go through this period and it's okay until people start realizing that actually that we're getting pretty close to the last line of defense, which is the house.
Yeah.
So we've got to stop everything else.
Yeah. Yeah.
Sure. Look, I think it'll happen. The question is, how long is it going to take?
Yeah.
But everyone's talking about this collapse, like literally a cliff.
Imminent. Yep. Where you're talking more, it's a death by 1,000 cuts, sort of slow decline.
Yeah.
And
it's like water torture, right?
Yeah.
And we're almost going through water torture. How long are we talking about recession for? Like one year. Now everyone's pushed it out to the second half of 2023. I'll bring this chart up again from not from Deutsche, but from Apollo. Torsten was at Deutsche. That's why I keep getting confused. The unemployment rate goes down when the Fed raises rates. So let me see this chart. The green line is the Fed funds rate, and the blue line is the unemployment rate. And what Deutsche Bank is saying is that the median time that it takes from when the Fed starts hiking until the unemployment rate bottoms and moves high is 14 months. And using this historical pattern as a guide, with the first Fed hike in March 2022, we should begin to see the unemployment rate increasing within the next couple of months. The bottom line is it usually takes 12 to 18 months for the Fed to soften labour market, and today's no different. So all the work's been done, and now you kind of just got to sit back and just now see what happens. What impact does this have? Clearly, we've had a lot of stress in the banking sector. But, I mean, all of, and we'll talk about this later on as well, all of that's, we've had 3 enormous bank failures.
Yes.
What's happened?
In 8 weeks.
What's happened? Nothing.
Well, yeah.
Shareholders been wiped out.
Business confidence is lowered. Cost of capital is higher. Liquidity's gone down.
So we haven't seen the full impact yet.
Well, it's working its way through, I'm sure.
To your point, this is from Apollo again. Apollo is a big source of charts this week. Tighter bank credit dragging down bank lending. Smaller businesses reporting it's harder to get a loan, and that normally means lower bank lending growth over the following 12 months. And so what this chart is showing is NFIB small business credit in the blue line, US commercial bank asset loans and leases year on year. That's already turned. And so if you look back in history, what this is saying is you're going to just start to see commercial loans start deteriorating as well, which obviously has an impact on the economy and the flow-on effect as well. I think this is, I've got a couple more to go here. This is from Yardeni Research. I'll bring this chart up now. It's their boom-bust barometer. What it looks at, it takes into, they call it their BBB. It's the ratio of the CRB Raw Industrial Spot Price Index to initial unemployment claims on a weekly basis. Yardeni says that it's a very useful high-frequency business cycle indicator. Like the index of coincident economic indicators, tends to peak at the tail end of booms and bottom at the end of recessions. They go on to say, so far, conclusion is that the BBB is consistent with our rolling recession outlook, aka a soft landing. So what you're hearing anecdotally the headlines that you're seeing doesn't seem to be translating into the doomsday scenario that everyone's probably pushing at the moment.
Yep.
The numbers are just not suggesting that. And I'll wrap up on this topic with this is from a summary from Bespoke. We've had S&P 500 companies starting to report. Bespoke says we've tracked results from 937 names. And when we compare that body of results to the results from the same cohort of companies in the prior earnings season, the results so far have been pretty good. The beat rate for announcements this quarter is running at 72% for EPS versus 65% last quarter, which is 80th percentile since 2001. Revenue beats are also up almost 70% compared to 65%. The rate is in the 84th percentile to prior periods. So have a look at that. Like,
it's interesting. So nothing's as bad as it seems.
Well, everyone's been calling for this earnings recession, right? And let me just bring this final chart up now. This is the percentage of companies raising and cutting guidance. So have a look at that dark blue line, right? Guidance raise.
Yeah.
It's kicked up. So maybe that whole earnings recession, like everyone's talking about how it's going to drag on or not, maybe we've already had it. Maybe the decline in the stock market was already predicting that earnings recession we've seen over the last couple of quarters.
But at the same time, maybe guidance has been lower because all companies are not raising their guidance, saying that
100%.
we're gonna anticipate it's going to be really bad,
and maybe it hasn't been as bad.
And it hasn't been as bad as everyone thinks. Right?
It's a game of relativity, right? Yeah. And so you've got we were talking about Apple previously. We're talking about the Nasdaq, how well it's been performing. It seems to me, and if you look at small caps are lagging, like the banking sector in the US at the moment, where you've got this divergence between the big and the small. Here you've got S&P 500 companies, Europe's largest stocks, the Nasdaq diverging from the likes of small to mid cap stocks. Maybe that's what the game is like. It's quality of the company.
Flight to quality. Yep.
That's what appears that we're seeing at the moment.
I think you're right on that. I think you're right.
Hey?
I think you're right on that.
Well, that's what the data's showing.
Yeah.
Any other thoughts or comments about this? Like earnings are pretty good. The economy's not as bad. Things are looking. We haven't seen the full effect. We haven't seen the implications of rate rises. I think inflation's in the bag. We're done. I think that's going to take care of itself. But what are the consequences now as it relates to the broader economy?
That's right. What's the consequences in relation to now a recession and a hard recession, where if we've got rapid rises in unemployment, spiraling liquidity, businesses going into administration, more businesses going into administration, and the spiral effect that has on household wealth. And that's still going to play out, I think, over the next, according to you, 18 months, right?
Well, since the first rate hike, so March 2022. Yeah. So we're 12 months in.
So another 6 months.
And I think that's why the likes of Deutsche Bank, the likes of Apollo, and these big investment banks and research houses are saying second half of 2023.
Yeah. Yeah.
And that's probably a pretty good guess.
Yeah. I mean, it's anyone's best guess whether, they can navigate through this tough time, right?
Look, it's non-negotiable. We're going to have a recession. The question is how severe the recession is. I think that's the real question. No one's going to guess the timing of it all. By the time you're in a recession, so by the time the recession's been confirmed, you're already in it. You have to be getting out of it to know that you're in a recession. So that's just an impossible task. I think it's
at least we know that governments and central banks are acting quickly to, maintain confidence in the market and make sure there's less of an impact on the citizens, right?
Yeah, but I mean, they're talking a lot of shit, and what's going on in real life, which I've got some charts on later on. What they're saying, they're trying to instill confidence that the banking sector's fine. Meanwhile, you've got banks all around the country in the US falling by 30, 40, 50% and into the weekend, and they're trying to negotiate deals over a weekend.
It's like there's a fire in the background and
everything's fine.
Everything's fine. Everything's
fine. Over to you. I think.
I think that sort of leads into the situation in the US with their debt ceiling currently. So Yellen warns Congress Treasury may run out of cash soon as June. So the 1st of June, they're saying. So, I mean, that's... we've been here before many times.
Every time.
Every time. So I'm sure they'll work it out. But supposedly there's some big political standoffs happening, and it's really a game of chicken with no party wanting to compromise. So it's going to be a pretty tight showdown. They don't have long. They hit the current statutory limit of $31.4 trillion in January. If we look at the charts, as you can see, the US Treasury has run down cash to make payments. They don't have much left. And if you look at the second chart, the debt limit was hit pretty quickly over the last couple of years.
What's that uplift, the draining of cash in the previous chart? Does this kick up?
Yeah, that's a good question. I'm not sure. They've obviously got some cash from somewhere.
Debt limit. I mean,
some temporary.
I feel like we have this same conversation every single time.
Yeah, and I mean the only time in the past it really hit the markets was 2011, where the S&P dropped 17% as a result of this. There's a number of big factors. I think there was another time it dropped 2%.
2%, come on.
Yeah, which is not much, but yeah, I think the only big time it happened was 2011, and that saw major damage to U.S. consumer confidence, sharp sell-off in equities, even though lawmakers were able to act on time. So I mean, there's a lot of factors that are going to affect whether this actually tips the market. Really, what happens is if there's a continuing to butt heads between the two parties and they don't do it, potentially it's a tipping of the market that forces their hand to actually do something about it, whether they temporarily increase the limit or suspend or take some other actions. But yeah, it'll be interesting to see if they sort of, the push and a decrease in financial markets actually forces them to compromise and increase the limit. But we all know that they'll probably reach an agreement there. It's going to be messy, but they'll probably reach an agreement and negotiate.
Agreed.
But yeah, that was an interesting one, I thought.
I don't know why we didn't make this one the first topic, which is the one big thing. First Republic gets seized and sold. This is a really good summary that I picked up from, I think, Ticker. Can't remember. So JP Morgan will assume all First Republic's $92 billion in deposits, even the ones that were uninsured.
Okay.
I did not know that. The cost is lower than what would have been expected. So they're talking about there's a change of control. JP Morgan will have to mark First Republic's loan book to market, realizing losses on the loans. Those loans will be shared with the FDIC at a cost of the insurance fund of about $13 billion.
Wow.
Less than the $30 billion or so that the market were expecting. In relation to the shareholders and bondholders, both are expected to be wiped out for the time being. And for the time being, First Republic's execs are now employees of JP Morgan. They go on to talk about how the bank regulators have made it pretty clear in recent years that it's never their preference to allow too big to fail banks to grow by acquisition, but what we're starting to see over the last three failures is that concern seems to be sort of disappearing on its own. The California Department of Financial Protection and Innovation, which was First Republic's primary regulator, stated in a press release that the bank had become unsafe or unsound. And so any deal that gets announced at 4:30 on a Monday morning is going to be messy, and we've seen this week.
So why have bank regulators said that their preference is not to allow too big to fail banks to grow by acquisition?
Why do they not want them to grow by acquisition? I don't know. The things that come to my head is whether it's by acquisition like this or by acquisition with a proper purchase. I mean, you've got, I don't know whether JP Morgan or whether Jamie Dimon was just sitting there, literally like vulture, just waiting for this thing to hit the fan and come in there and pick it up, or not. But they're not. They're obviously not going out and spending money to acquire anything. I don't know. I don't know why they don't want them to grow. I mean, it's no different to in Australia where your big banks become even bigger.
Yeah, but anti-competitive.
But what is the alternative in this scenario, whereby no one acquires First Republic? I mean, First Republic is not a small bank. They're not just from what I understand, they're a bank that looks after some of the country's most elite clients, like the uber wealthy clients and families is the clientele of First Republic. So JP Morgan basically pick up that clientele as well. So it's a white glove service that First Republic's paying. I'm not an expert, but that's from my readings. But what's the alternative? You let the thing just collapse, and the government gets nationalised, and the government has to pick it up, and then what?
Yeah.
I mean,
they don't have many alternatives.
The whole too big to fail. They're already too big to fail. Like, it doesn't matter anymore. I almost feel like. So this was a quote from the Fed. Going back to what you were talking about before, the US banking system is sound and resilient, unquote. And then a few hours later, the press conference. Few hours after that press release, you had PacWest, which is, and I don't even know who PacWest is, but they're exploring strategic options, including a possible sale. So PacWest, another bank in the US, their shares are already down about 80% since February. And then after that news came out again on Bloomberg, their stock just got cut in half again. Bloomberg, overall, the banking system...
So PacWest Bank is the 53rd largest US bank, and it's got $44.3 billion. Total assets of $44.3 billion.
PacWest doesn't come up on this chart that I'm going to bring up in a second. But Bloomberg go on to say the overall banking system may be sound and resilient, but there's clearly anxiety surrounding the individual banks that hasn't gone away. And I think Ackman's tweet this morning is pretty spot on. I'll bring this chart up. This is US regional bank deposit outflow. And you can see, have a look at the one that's highlighted, First Republic, outflow of almost 60%. Western Alliance down there, if you can see, 11% of their deposits have outflowed.
Charles
Schwab. Interestingly, Bank of New York Mellon is getting inflows in. Huntington Bank shares got some small inflows in as well, small. But look, this is a real thing now. People are pulling money out, and it just turns into a classic bank run. So something. I mean, we were talking about this when SVB failed. How regulators came in super quick, reassured everybody that it's all good, it's all okay, we're here. But no, it's
just a small band-aid.
We're not done,
trying
right?
to patch a dam.
Correct. This was from Deutsche Bank. So far in 2023, the FDIC have taken over 3 US banks with combined assets of $548 billion. This is 2% of GDP. They were SVB 200 billion, Signature Bank 110, First Republic $230 billion. And the chart showing the total value versus GDP. What's really interesting, if you have a look at the Great Depression, 10,000 banks failed.
Wow.
I didn't even know how there were 10,000 banks, but that's what Deutsche Bank are telling us. Almost 6.5% of GDP. The savings and loan crisis, 2,000 banks failed, which is about 3% of GDP. GFC, 500 bank failures, 2.5%. We are now had 3 bank failures. You talk about too big to fail. What are we talking about now? 3 bank failures, we're at 2% of GDP. 3.
It's nuts.
It took 500 banks in the GFC to get to that level.
Well, it looks like this is just the beginning.
What do you think about all that? Like, is it just the beginning? Are we just living in a very different world now? Like,
I think it's the beginning. It's the domino effect. there's still a lack of confidence in the banking sector, which means that there's just going to be more outflows. And as more banks start to fail, there'll be more of a bank run.
But doesn't that just mean that you've got the big banks stepping in and just having the luxury of choice to pick up whichever customer base they want?
But cost of capital still rises, shareholders still get wiped out, liquidity still decreases, right? That's got to have a pull on economic growth.
What does it mean for the stock market?
It's a good question. Maybe we see another decline.
I mean, you're making comments about business failures and the economy. The reality is the economy is not the stock market, right? And the stock market is not the economy.
Yeah, we talked about that last week.
Yeah, and we saw it through 2020. We've seen it in a number of instances. Like there could be a whole bunch of stuff going on in the real economy that is just not impacting the stock market, because what the stock market is not a true reflection of your everyday mum and dad business, or is not the same as, I don't know, a JP Morgan, right? So what's happening with thousands of business failures or thousands of people defaulting on their loans? Like, it just to me looks like just a drop in an ocean. It's just two completely different things. So I think it could be possible that we could be seeing all of the things that are going on, like we have seen during October, November, December, Q4 of last year, Q1 of this year, where the economy was still in the shit. But we just saw the Nasdaq's up 21%.
Yeah,
European stocks are up 15%. I mean, that is not even an average return in any given year. You've got average returns of 9, 10, 11%, right? And you've had this in 5 months.
It's a massive disconnect, right?
So whether, and my take on this is, the US seems to be starting to go through a very similar process that we go through, right? Like you've got your majors, and you've got the regionals or the smaller banks, and you're just going to this flight to quality.
Yeah, yeah.
And and when you talk about flight to quality, you're talking about the world's best 500 companies. If you're talking about the S&P 500, they are the elite of global companies. And so maybe we just tick along and everything's fine. I don't know, to your point with the fire in the background.
Well, we still had Credit Suisse fall. This doesn't take into account, big bank failures like Credit Suisse too, right?
The European stock market's up 15%.
It's still up 15%.
Do you know what I mean? Like, again, I think what goes on in the economy and what happens in the stock market are very two different things. And maybe last year's decline was preempting all the shit that we're going through right now.
Yeah, that's right. Maybe we're still looking through. Maybe we're not.
Time will tell.
Time will tell.
I don't have anything else on that topic. Do you want to add anything?
No, I think that's a good summary. I think we're still waiting and seeing.
Jump into director's cuts and...
Yeah, this is an interesting one that you've got put up here.
Oh, you want to do yours first?
No, you do yours.
All right. So I saw this last night. I'll bring this up, first one.
Oh, yeah, I saw this.
Thin review, where 3
Classic.
experts would invest $10,000 if they were 25. So you're 25, you got 10 grand. These experts... so just flicking through, I don't know, there was 3 of them, obviously. The third one, I left the best till last. I'll bring this one up. This is Christopher Joy, Coolabah Capital Portfolio Manager. Take a beat, look to cash, then load up to risk. What the fuck does that mean?
Bide your time. Bide your time until markets get smashed a bit more. That's what he's saying.
Is that what he's saying? So he's saying take a hit.
Take a hit, just stay in cash. Wait till the market's severely in pain and then go in and take on some risk.
Okay. So when's that?
Only the experts know, my friend. Only the experts know.
The expert fund that's been underperforming the bond index for however many years. Like, come on, man. You're 25, right?
Yeah.
Okay, you're on stage with Chris Joy and whoever else is on this stage.
Yeah, and he says put money in a term deposit.
What would you say if they turn to you and say, Jonathan Sim, you're 25, where would you invest $10,000?
Well, if we had a retail fund, I'd say put it in the Ecom Capital retail fund.
But where would you put the money?
Look, it's a tough one. It's a tough one at the moment. I think if you were going to take risk. I'd be taking short-term risk. I don't know. I've got a different different risk tolerance from a lot of people, though.
So where
but we
are you
were
investing?
talking about index funds and ETFs and looking at, depending on your investment horizon, longer term duration, right?
They're the facts. That you're 25.
Yeah, well, you've got a long term.
Clearly, you've got a long term horizon, right?
You've got a long term horizon.
So where are you investing 10 grand?
Well, I read an interesting Vanguard article comparing putting 100% fully invested versus progressive investment, and they're saying 100% wins.
Yeah, 100%.
All the time.
Mate,
so
just put the answer's easy. Just put the money into stocks.
Yeah.
That's the bottom line.
Put it into an index fund.
That's
ETF.
the bottom line. Yep. That is the bottom line. All of this take beat, look to cash, load up. Fuck off. Like, it's such a waste of time. The research, there is ample research that just says it doesn't work.
I think it works for people that live it and breathe it day in, day out and understand the risk.
These people do.
Yeah, but they're advising people who don't understand the risk, right? So you're
but
right. If you don't understand the risk, that's what you should do. You should go.
No, but if someone tells you to do this, take the beat, look to cash, load up on risk.
Yeah, they're not going to know how to load up on risk later on either. Yeah, but what risk are they going to load up?
But he, as in, not whether it's Chris or anybody else, any portfolio manager should be able to do that, right? Is that what they're saying that they're doing for their clients or their investors or not?
Don't know.
There was another article. Who was that? Roger Montgomery. Roger Montgomery said, "Don't be." This is my interpretation of the article. Don't be young investors. Listen up. Don't be fooled by what the. Did you read this article? Don't be fooled by what the index people are telling you. Investing long term, there is value in actively choosing your stocks. Anyway, he went on basically indirectly saying, "Do not touch index funds and invest."
Oh, yes. I did see that one.
And mate, he got grilled on. I think
on his fund performance. Remember what we said? Whoever makes these claims should be putting their fund performance there 100%. As a track record.
And everyone's gone out to him. In fact, I think I said this to you. I drafted something and then I'm like, no, I was just so frustrated and angry. I just deleted the message. But if you're going to go out and make these claims, you better back yourself, man. Because if your funds are not performing in line with what this bullshit, yapping is, then shut the fuck up. Until such time you've got your funds performing in line with what you're saying, I'm not interested.
Yeah, 100%. I 100% agree with that.
100%. I think someone made a comment saying, Roger, you've got 9 funds in your suite. 7 of them have severely underperformed the index. Like the odds of you succeeding, it's just, why would anybody do that?
Yeah.
Anyway,
we've gone into the risk around individual active management versus
it's crazy.
not.
Look, I think in public markets, it's so hard. We've talked about this before. The information rich, the liquidity. There is so much going on that in order for you to have your edge and outperform the broader market, it is probably more luck than skill. I think that exists in private markets where you don't have information, you don't have market equilibrium. You just don't have it.
No.
And until such time as private markets become publicly traded, where you've got that, what's the right word? What do they say? Anyway, until public markets become until private markets become akin to that of public markets.
Yeah, where you have that flow of information.
Right? Whether it's rational or irrational, I don't know. I think all markets are rational and irrational at the same time. I just don't think it's not impossible. It's just low probability.
Very low.
Don't roll the dice on that. That's my rant over. What do you got?
I got an article from The Guardian. Very interesting. So the godfather of AI, Geoffrey Hinton, quits Google. Right. So this is a pioneer. He was a pioneer of neural networks, and which led to ChatGPT. And he's been instrumental behind Google's AI program.
Right.
And he quit.
Didn't that flopped?
Yeah, well, it's still working. Bard, yeah. They're still working on it.
Okay, that's good.
But he reckons, he was at Google because he thought they were a proper steward of the technology. And now,
did he help set up Bard or Baird?
Yeah, I think so.
Right.
So he reckons now it's posing a serious harm to humanity, as with Elon Musk and a lot of other people saying that there's big risks with this.
What's the risk that the robots start shooting everyone? Like,
yeah, I mean, well, we talked about Palantir and their basically brain for military warfare. Yeah. Then you've got your robotics of a robot basically shooting firearms, foot soldiers. Just link AI to that and see what happens, right? So they're saying, look, could pose some serious harm. We might see some Terminator style.
What's the solution to that? Like, bunker down? Like,
I don't know.
By gold?
Air gap this, not let it onto a network. I don't know how you deal with it.
What do you do there? Do you buy gold or do you buy Microsoft?
But you can't stop it now. There's just so many players developing this out, right? I think
that's the thing. Like every week, I get updates on new technology. Like here's the thing that can, I don't know, block ad pop-ups. Here's the new AI that can reorganize your diary. There's like an AI for everything, man, and everyone wants
This is the new age, right? Yeah. I think Ashton Kutcher just launched a VC fund for AI, and they closed in 5 days.
Of course it did.
Yeah. I can't remember how many, 5 or...
Do you think there's going to be a bubble in AI? Like, is this... You've got...
It's the next tech boom, right? Or the next internet. But, I mean, what was really interesting to me is what is true, what is reality, and what's fake news now. You've got issues with Fox News. I don't know if you heard about that, where they were sourcing credible sources, and those sources were sourcing credible sources from someone else. And then those sources were sourcing from not so credible sources, right? So then you're going, well, who's doing the fact checking?
Yeah.
And what's reality? Like, look at this image, right? So this was AI generated of the Pope wearing Balenciaga, and this went viral.
What is that, man?
This went viral, right? The Pope wearing Balenciaga, and it's obviously not real. Looks pretty real, but
that looks so cool.
Yeah, pretty cool. And yeah, just
can you imagine getting baptized in that, like,
awesome.
It would be waterproof.
Yeah. So people are generating content from everywhere, and what they're saying is spam bots can just create more and more spam, more fake news. What do you trust anymore? And I think that's pretty interesting.
Do you think this is going to be like even more reason for people just disconnect from everything? Like
maybe.
How do you get away now? How do you get away from this?
It's impossible. Go back to those Encyclopedia Britannicas.
I don't think that's a solution. I saw again, whether it's fake news or not, but a lot of millennials or whatever. I feel old now that I'm referring to younger people. People are buying now non-smartphones, and Nokia, those old Nokia phones. People are buying those phones now just for phone call and text messaging. So it obviously doesn't have the capability of, internet and all that stuff. So people are buying phones and using them like throughout the week, and then might be using a smartphone on a weekend or something like that.
Right. I like that. Digital detox.
Digital detox. Yeah, correct. So maybe Nokia will come back from the grave.
Yeah, maybe. Or BlackBerry.
Far out, BlackBerry. Do you have any tips and recommendations? I've been moving house this week, so I've been inundated, man. I haven't got anything. I'm sorry, but actually, instead of using bubble wrap, trying to do our thing for the planet, we bought this paper, rolled up paper that you it's like honeycomb paper.
Yeah, very cool.
It's all recyclable stuff.
Yeah,
so
amazing.
I'd love to see more and more of that stuff being.
Have you seen the mushroom packaging?
The mushroom packaging.
Yeah, they use mushrooms to create styrofoam almost.
Really?
Yeah.
Wow.
Yeah, that's pretty cool.
We've got a new fridge that came, and it made every part of the fridge has got some sort of foam on it with
and tape and
clear film and sticky tape. Everything. I'm like, far out. This is out of control.
Massive wastage.
Total waste.
Yep.
So anyway,
I like that.
I haven't had an opportunity, man, to really do much this week. You've got anything for us?
Went somewhere last night. Mm-hmm. Pretty amazing.
Where did you go?
Another omakase.
Another one?
Yeah. Sushi on. This is in Camberwell. It's the old Kisume head chef.
Oh, yeah.
10 seats.
10 seats only?
10 seats only. Pretty hard to get a booking as well.
Looks very bespoke, very
boutique.
boutique.
Very cool. Very cool. Food was excellent quality. I went with a mate, and
Is
we
it
reckon. Q. Sorry, I thought it was
Burke Road.
Yep, Burke Road. And we thought that it was on par, if not better than Minamashima.
All right.
So definitely check it out.
So were you and all the celebrities there last night?
There's a good crowd last night. 2 birthdays.
Oh, yeah.
No celebs last night.
No. You were there.
Delicious food though.
Is it?
Delicious.
Yeah, okay.
I don't know if they do veg.
No. Well, we're going to... there's a new plant-based sushi train opened up in... Do you remember the old towers on Don?
Oh, yeah.
Yes, they've shut down. They've now... I think it was the same owners
Right.
from another place. They've shut the 2 venues down and created this one for plant-based sushi train.
Very good.
We're going there tomorrow night. So I'll let you know next week whether it's good or not. But yeah, the kids love sushi train. So first time trying this one, so we'll give it a go.
Excellent.
All right, we'll wrap up. Catch us on LinkedIn, YouTube, and Spotify, and we'll catch you next week. My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526 798. The information contained in this podcast by me and or our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.